You've probably seen people hyping the next big stock, but here's something few talk about. One of Fidelity's index funds charges 0 fees. That's right, 0%. And surprisingly, it performs right alongside funds that have decades of proven history behind them. Now, think about this. A $10,000 investment growing into more than $500,000 over time, all by cutting costs down to almost nothing. By the end of this video, you'll see how lowering fees isn't just about saving a few dollars. It's about unlocking exponential growth that could transform your financial future. But first, let's talk about what those tiny, invisible costs really do to your returns. For many investors, the idea of free investing feels like a reality. No trading commissions, no service fees, and sleek apps that make buying and selling effortless. But beneath that shiny surface lies a quieter cost: the fund's expense ratio. It doesn't show up as a line item on your account or a separate bill each month, but it's there, quietly reducing your returns year after year. That tiny percentage doesn't sound alarming at first, yet over time, it can drain a surprising amount from what your portfolio could have earned. Here's the real issue. While the market itself treats every investor equally, compounding doesn't. Let's take two investors who each start with $10,000. Both stick with it for decades, both reinvest dividends, and both experience the same market performance. The only difference is the cost of their funds. One pays a 1% annual expense ratio. The other pays just 0.015%. Over 30 years, that small difference in fees could cost you tens of thousands of dollars in lost growth. Not from bad luck or timing, but simply because one investor kept more of what compounding produced. That 1% might sound harmless until you see how it compounds in reverse. Each year, a piece of your return is skimmed off before it can generate more earnings. Over 3 decades, that modest fee can erase a quarter or more of your potential gains. You earned those returns, but they never made it into your pocket. And because the cost never appears as an obvious deduction, most investors underestimate its impact. Market dips make headlines. Expense ratios don't. Yet, it's often the invisible drag that makes the difference between reaching financial independence and falling short. This is where behavior plays an enormous role. Many investors obsess over daily price swings and news updates, while the steady leak of fees continues unnoticed. Our brains aren't wired to feel pain of small percentages, especially ones labeled just 1%. But over decades, those unremarkable numbers quietly become 5-figure losses. Research consistently finds that lower costs are one of the strongest predictors of better long-term performance. Funds with minimal expenses don't outperform because they outsmart the market. They outperform because they let investors keep nearly all the market's return. That's how low-cost investing becomes such a powerful advantage. When fees shrink, more of your money stays in the market, compounding on itself, building momentum each year. Every dollar that doesn't go into management costs is a dollar that can grow into many more. Think of it as trimming unnecessary drag so your portfolio can run at full speed. The fund doesn't need to be fancy, it just needs to be efficient enough to let compounding do its work without interference. Consider the contrast between typical actively managed funds and a low-cost index option. Many actively managed funds still charge around 1% annually, $100 for every $10,000 invested. Meanwhile, Fidelity's index funds have brought that number astonishingly low. One of them, with an expense ratio of only 0.015%, costs about $1.50 per $10,000 each year. That's the cost difference between buying a full dinner and buying a single cup of coffee every year for a decade. It might not seem meaningful at any single moment, but compounded over time, it becomes a defining factor in total wealth. This is the quiet revolution in investing, shifting focus from chasing big wins to reducing small but constant losses. Fidelity's approach of minimizing or even eliminating fees helps investors capture the full benefit of compounding without friction. The less money lost to costs, the more freedom investors have to let time and growth work in their favor. And this philosophy becomes especially clear when we look at one particular fund known for both its efficiency and performance: an index tracker with annual costs so low they barely register. Most investors spend years chasing the next hot stock, but the real powerhouse might be a fund that costs about as much as a single cup of coffee each year. That's the entire annual expense for holding $10,000 in Fidelity's 500 Index Fund, better known as FXAIX. This fund is designed to track the S&P 500 and charges an expense ratio of just 0.015%, meaning you'll pay only $1.50 a year for every $10,000 invested. It holds the same 500 large US companies that shape the economy, delivering returns that almost perfectly mirror the index itself. For a cost this low, it's an efficient engine for long-term wealth building. It's easy to wonder how a fund charging so little can perform just as well as the ones that promise expert management for 50 or even 100 times the cost. But the numbers make it clear. Over the past decade, FXAIX has produced average annual returns close to 14%. In the most recent 5 years, that's edged higher to around 14.7%, and in the last year, it surpassed 15%. Each of those figures closely track the S&P 500 itself, showing that low cost and strong performance can absolutely go hand in hand. When you invest in FXAIX, you're not just buying into an abstract market tracker, you're becoming a shareholder in some of the most influential businesses on the planet. You're participating in the innovation of Apple, the cloud computing leadership of Microsoft, and the artificial intelligence revolution led by NVIDIA. You're investing in the everyday companies driving commerce, communication, and progress across the country. Instead of betting on which stocks might win, you own a small slice of nearly all the winners, automatically capturing their collective growth. As the US economy expands, your wealth grows with it. Here's how that growth looks when compounded over time. Based on the fund's historical average annual performance of about 14%, a $10,000 investment in FXAIX could grow to roughly $37,000 after 10 years. Let it run for 20 years and it reaches around $137,000. Over 30 years, the same $10,000 could climb to more than $500,000 without adding another cent. These projections assume you keep reinvesting dividends, which is key to unlocking the full potential of compounding. Those quarterly payouts from S&P 500 companies may seem small, but over decades, reinvested dividends can account for a substantial portion of total returns. Each time dividends are reinvested, they become fresh capital that keeps compounding right along with your principal, accelerating growth year after year. Staying invested through all market conditions is just as important. Volatility can make investors nervous, but long-time data shows that missing even a handful of the market's best days can drastically reduce total returns. The design of a fund like FXAIX encourages consistency. It rewards those who stay the course and let time smooth out the short-term noise. You don't need to outguess the market. You just need to stay in it, allowing compounding and reinvested dividends to do their work without interruption. FXAIX proves that strength doesn't have to come with complexity or high costs. Its simplicity is what makes it so effective. Every fraction of a percent you save in fees is instantly converted into more growth potential. Over time, that advantage compounds into a noticeably larger balance, turning efficiency itself into added performance. It's a system built around investor benefit instead of management overhead, giving everyday savers a framework that can rival professional portfolios. And while FXAIX covers America's largest companies, some investors prefer to go a step further, seeking exposure beyond those 500 giants to include nearly every publicly traded US company. That broader strategy adds another dimension of diversification while keeping costs just as low, offering a way to own almost the entire market in one move. While FXAIX focuses on the 500 giants that dominate the US economy, Fidelity's Total Market Index Fund, FSKAX, takes the concept a step further. Think of it this way. If the S&P 500 fund is like owning the biggest players, FSKAX is like owning the entire team. It captures nearly every publicly traded company in the United States, large, mid, and small caps, spreading your investments across about 3,800 individual stocks with a single purchase. That reach makes it one of the simplest ways to gain exposure to the full spectrum of American businesses, from today's market leaders to the startups that could define tomorrow. And here's what makes it especially compelling. FSKAX provides all that breadth while charging the same rock-bottom fee as FXAIX, just 0.015%. You're not paying extra to hold thousands more companies. That combination of scale and low cost creates what many investors consider the best of both worlds: widespread diversification without sacrificing efficiency. Your money automatically flows into companies across technology, healthcare, energy, finance, and even lesser-known sectors, keeping your portfolio balanced without requiring any hands-on management. A question naturally comes up. Does this broader approach actually change long-term performance? Interestingly, the returns have been nearly identical to the S&P 500 over time. Over the last 5 years, FSKAX has delivered an average annual return of about 14.06%, and its most recent one-year return tops 15%. That consistency shows that owning the total market doesn't mean giving up growth. Instead, it means capturing every part of it, whether the market's momentum is driven by tech giants or smaller, faster-moving innovators. The real advantage shows during shifts in market leadership. When large-cap stocks start to plateau, smaller companies often step in with bursts of higher growth. FSKAX is built to capture those moments automatically, functioning like a self-rebalancing system that adjusts as conditions change. Inside those thousands of holdings could be the next Apple, Amazon, or Nvidia in its early stages, the kind of company that delivers explosive growth before it ever makes headlines. Owning the total market ensures you're already invested when those breakthroughs happen, without having to predict which company will lead it. This approach also echoes one of the most enduring philosophies in investing, championed by Jack Bogle, the legendary founder of Vanguard. Bogle often said the most reliable strategy for long-term success wasn't trying to pick winners. It was buying the entire market and holding it for decades. FSKAX embodies that idea perfectly. One fund, total ownership, and the patience to let compounding handle the rest. By removing guesswork, it replaces speculation with a disciplined system built for steady progress. For most investors starting with $10,000, the math still looks remarkably strong. Assuming a 14% long-term average return, that initial amount could grow to roughly $500,000 over 30 years, with dividends reinvested, just like FXAIX. The difference isn't in return potential, but in how exposure is distributed. The thousands of companies inside FSKAX help smooth volatility. When one sector struggles, another often offsets the decline. That cushion can make the experience of staying invested less stressful, which is an overlooked but vital part of real-world success. Beyond performance, the psychological benefit of owning the total market can't be understated. You no longer have to wonder which sector or company will lead next year because you already own all of them. As the economy evolves, FSKAX automatically updates its composition, increasing positions in growing companies while trimming exposure to those that shrink. That adaptability gives investors confidence to stay put throughout downturns, knowing that long-term market growth continues working on their behalf. So while the difference between FXAIX and FSKAX might feel small on paper, the broader play offers meaningful peace of mind. You gain vastly expanded diversification, a share of future innovation, and a strategy grounded in some of the most time-tested investing principles ever proven. And as effective as those low-cost funds are, Fidelity didn't stop there. It pushed the boundary even further with a fund that dares to eliminate fees altogether. How can a fund charge zero fees and still perform alongside the most established players on Wall Street? That's the intriguing premise behind Fidelity's Zero Large Cap Index Fund, ticker FNILX. It's a bold step in Fidelity's ongoing effort to push investment costs as close to zero as possible. This fund tracks large-cap U.S. stocks much like the S&P 500, but with one crucial difference. Its expense ratio is exactly 0.00%. There's no fine print or temporary offer. You invest, and absolutely none of your returns are skimmed away for management costs. Launched in 2018, FNILX is still considered new in index fund terms, which can make some investors pause. They may wonder whether a fund this young could sustain its quality, or whether the zero-free model is just a flashy marketing tactic. That hesitation is understandable. Most investors take comfort in long track records that have weathered multiple market cycles. Fidelity's reasoning for FNILX, however, is quite strategic. The company uses it as a way to attract new investors, inviting them into the Fidelity ecosystem with a cost-free entry point. Once those investors experience the platform's convenience and performance, many naturally explore additional Fidelity products and services. It's a deliberate, competitive move that reflects confidence in the firm's broader financial model while giving individual investors a powerful new advantage. Even with its short history, FNILX has built an impressive record for consistency. Since inception, it has delivered an annualized 5-year return above 14%, almost matching the S&P 500. More recently, 1-year results have topped 16%, with 3-year returns close to 20%. The number looks almost identical to FXAIX, and for good reason. FNILX tracks a proprietary Fidelity index that's very similar to the S&P 500, composed of the same kind of large U.S. companies that drive overall market performance. By building its own benchmark internally, Fidelity avoids licensing fees associated with using the official S&P name. Those savings are passed directly to investors, allowing FNILX to maintain market-matching returns while truly eliminating management costs. If this consistency continues, the zero-fee advantage becomes more than just symbolic. It compounds. Consider an investor who puts $10,000 into FNILX, while another chooses a low-cost alternative charging only 0.015%. The cost difference seems trivial at first, barely more than $1 per year, but over decades, that small margin accumulates. Without any annual fees reducing returns, compounding works with full force. Even a minor edge of 0.015% becomes meaningful as it builds upon itself year after year. Over the long run, that could translate into several $1,000s of additional growth without taking on any extra risk. The fund's youth remains its main question mark, but also its opportunity. Time will tell whether FNILX can maintain its precise tracking performance across full market cycles. Yet, if it does, the potential payoff mirrors what we've already seen with Fidelity's longer-standing index options like FXAIX and FSKAX. Starting from a $10,000 base, continued returns near historical S&P 500 averages could propel an investor towards roughly $500,000 over 30 years. In that scenario, FNILX wouldn't just match traditional funds. It would deliver those same incredible heights with the added benefit of zero ongoing costs. More than just a product, FNILX represents an experiment in what the future of investing might look like. It signals that barriers to entry are dropping and that cost efficiency is no longer a competitive edge. It's becoming standard. As fees approach zero, the responsibility shifts entirely to the investor. Staying disciplined, reinvesting dividends, and letting time multiply returns. The mechanics of success no longer depend on fund managers, but on individual behavior, the decision to remain invested through the ups and downs that compounding requires. FNILX may still be in its early chapters, but its existence challenges long-held assumptions about what investors should pay for access to the market. If its performance trajectory continues, it could prove that uncompromised efficiency doesn't require decades of history, just disciplined structure and investor conviction. And that brings the focus back to where it belongs, not on cost, but on control. Because when fees disappear, the only limits left are how you invest, how you reinvest, and how long you're willing to let compounding do the rest. Small investors often underestimate how much control they have over their returns. Cutting high fees doesn't just save money, it removes the handbrake on compounding growth. When more of your earnings stay invested, time turns even modest contributions into something powerful. Start small, add consistently, and make sure the reinvest dividends option is selected in your account settings so every payout keeps compounding for you. It's a crucial step that dramatically accelerates long-term gains. The results won't happen overnight, but they build steadily year after year. If you found this helpful, remember to like and subscribe, share the video, and comment below which Fidelity fund, FXAIX, FSKAX, or FNILX, you're most excited about.